Today I'm with Tax-Free Mike. Today we're talking about one of the biggest financial secrets that the wealthy families use, how to create tax-free retirement income, build your own private banking system, and protect your money from market volatility using properly structured life insurance. So Mike, a lot of people hear the terms infinite banking, be your own banker, rich man's Roth. Can you explain in simple terms what that actually means and how properly structured life insurance can fit into a strategy?
So when we say becoming your own banker or bank on yourself, infinite banking, basically what we're using the life insurance policy for is like a saving substitute. It's replacing some of the banking functions that we traditionally use a savings account for. Because what's really your savings for? It's not necessarily to invest your money and double, triple your money because you bought NVIDIA at the right time, right? Savings is supposed to be a store of value, storage of your nest egg. And if you can get a little bit of growth on that money to stay ahead of inflation, even better. But your savings aren't supposed to be at risk. And now the problem that we have with your traditional savings vehicles, like your savings account, money markets, savings bonds, CDs, high yield savings accounts, is they don't pay enough of a yield compared to where the rate of inflation is these days.
Right.
The 80s, the 90s, you could get a decent yield in a CD or a money market. And inflation wasn't nearly as bad as it is today. So it worked a little bit in the 80s and 90s to have a decent amount of money in the bank. But nowadays, it's really lost opportunity. So we have to be so much more creative on where we can put our savings. And the life insurance policy just happens to be a more effective storage vehicle, a more effective store of value for our safe capital. And so that's why we call it become your own bank. We're using the insurance policy as a replacement for our savings because we can get much better growth on the money, better tax benefits, and stay ahead of inflation.
That is so powerful, man. So valuable. So Mike, when someone says that they use cash value insurance as a non-correlated asset class, what exactly do they mean by that? How is it different than traditional 401ks, stocks, bonds, things of that nature?
That's a really good question. So we use the insurance policy as a way to diversify a little bit more. And when we say non-correlated asset, what we're referring to is the value of the policy isn't going to fluctuate based on market fluctuation. So when you have money in your 401k, your Roth, an individual investment account, a brokerage accounts, things like that, anytime the market goes up, all of those things are going to ride the market and go up. But on the flip side, when the market's going down, all of those things are going to ride the market and go down. So when the economy in the S&P 500 are roaring, you're making money. When we're in a recession, you're losing money. Your principal isn't protected. You do have the ability to not only lose some of your gains, but also lose some of your principal anytime you have money in a 401k or a Roth or really any other traditional type of investment. Now,
the whole life policy would be outside of that paradigm altogether. It could never go down or lose value due to a market crash. Same thing with IUL, right? IUL, you can participate in some of the upside, but you're completely protected on the downside. Is that right?
Exactly. So the life insurance policy, we call it non-correlated because it's not actually correlated to the risk of loss in the market. When markets are up, like in an IUL, for example, you're going to earn interest and times are good. But when times are bad, you're not going to lose any money. You're just not going to make anything. So and there's some indirect correlation with an IUL with the market, but with a whole life policy, it is really truly a non-correlated asset. The market has absolutely zero impact on a whole life policy's performance at all. So with your cash value life insurance plan, it's a good way to, again, get some good growth on your money, stay ahead of inflation, get some competitive growth on your money without exposing yourself to market volatility, fluctuations, and downside risk of loss. So it's the percentage of your money that you want safe. And there's going to be different answers for that depending on who you talk to. Some people have a really conservative risk tolerance and they want no money exposed to risk. And some people are more comfortable with exposing themselves to risk and more comfortable with speculating and gambling with their money. So you might talk to some people and they want 80% of their money safe. And you might talk to some people and they only want 20% of their money safe. Whichever percentage of your money you want safe, we can allocate towards the cash value life insurance.
Absolutely. I think we need to talk about a properly structured IUL because it functions a lot differently than a regular life insurance policy where you're buying the most amount of death benefit for the least amount of cost. If you're doing what you're talking about, using life insurance as an asset, we're actually doing it completely different, right? We're taking like whatever money you want to put in, whether it's $1,000 a month, $100,000 a year, or or $200 a month. Whatever cash is going in, we're actually manipulating the policy to buy the least amount of life insurance allowable under the tax code, right? And so how would that change the fee structure versus a normal policy where you're trying to maximize the death benefit?
Right. That's a really good point. So the way we're using these cash value life insurance policies as savings alternative or an alternative non-correlated asset, we actually want to minimize the insurance portion as much as we can. These would be in full tax compliant with the law. So we need to have a certain amount of death benefit so that the IRS considers it an insurance contract. If you don't have enough death benefit, then they're going to tax it like it's an investment contract, which we don't want.
Defeats the purpose of tax-free Mike, right?
Exactly. We want to be able to access the cash value, no income tax liability. So we need to have a certain amount of death benefit required by the IRS to maintain the favorable tax treatment, but we don't want one more than that. So like to your example, let's say you're looking at a 30-year-old who wants to set aside $1,000 a month. Well, there's two things they can do. They can put away $1,000 a month into a life insurance policy and probably get somewhere around $1 million or $1.5 million worth of death benefit, of permanent death benefit that will never expire. Now, that $1,000 a month is pretty much going to go straight towards maintaining the cost of insurance for that million, 1.5 million death benefit. They're going to have very little, if any at all, cash value that they can actually tap into and use because the whole payment they're making is going towards maintaining the price of that permanent death benefit payout.
Sure.
Now, the other way we could do it is we could say, okay, well, we're still going to make the same $1,000 a month payment, but instead of like $1 million or 1.5 of death benefit, we're only going to buy $300,000 worth of death benefit. And what that's going to allow to happen is the vast majority of that $1,000 a month payment is going to go straight towards the cash accumulation, the cash account,
into the tax shelter of life insurance.
Right.
Mike, can you walk us through, because we talk about becoming your own banker, can you talk us through how policy loans work? Because much like we just talked about with the cost or the fees of insurance and how to structure it, that requires some nuance. And that nuance isn't something that your base level Primerica rep is going to understand, right? And same thing with policy loans. A lot of people hear loans, they hear the word debt. It's a 4-letter word. Debt is bad. Right. But the wealthy actually use debt to their advantage. If what you're doing, it can be really valuable. So explain how that works and how policy loans can be accessed tax-free, both now, like when you're younger in the accumulation phase of your life, but also in retirement, it can be really helpful as well, right?
That's a really good point that a lot of people misunderstand because if they're following your typical finance influencers, like anyone who's related to listening to Dave Ramsey or Susie Orman or what's the other guy who's big on YouTube now? Caleb Hammer, not quite like Dave Ramsey, but he's a little bit. You'll hear that you should not ever have debt, or debt, like you said, as a 4-letter word. Never take it out, only as an absolute last resort. You always want to be debt-free. And that's not at all how the wealthy think. The wealthy, they don't go into debt to consume. Like the middle class will go into debt to consume, to buy a car, to buy a watch, to buy shoes and purses and clothes and go on vacations. The middle class go into debt to consume and burn their seed crop. The wealthy go into debt to grow their wealth, to create businesses, to build assets. So the loan from the life insurance, it's not like you're in credit card debt to go buy a purse or like you have a car payment because you got a new truck. The life insurance loan, you can almost think of like a secure line of credit, almost like if someone's ever had any experience with a home equity line of credit. This is common with real estate investors. How do you buy another investment property? You get your first investment property. How do you springboard and get your next one? Well, you're going to need to bring cash to the closing table because when you're buying investment properties, there's no such thing as a zero money down mortgage, like with primary residence. You need to bring cash to the table. Well, where are you going to get it? Oh, hey, that first investment property that I got. What if I just borrowed equity out of it and I use that equity as the down payment to get my next one? And I have a tenant in there paying rent. They're going to cover the cost of that equity line of credit and I can get my next property. So the life insurance policy is almost like that. As we're putting our premiums into the policy, again, the vast majority of every premium dollar is building up that cash account rather than paying for a large death benefit that we don't really care about. And as that equity is building up in the policy, we can get a line of credit against ourselves to basically pull that cash out and go use it for something, buying a car, a down payment on an investment property, investing into our business, buying some vending machines, paying for our kids' college, or even tax-free income in retirement. And you can either pay it back to yourself so that you can use the money again, or if you're using it as income in retirement, you don't even really have to pay it back because when you die, The death benefit just cancels off any loans against the contract. And then what's left over from the death benefit after the loans have been washed out is what goes to your family.
Really interesting. Let me ask you this. For people who are business owners, high income earners, or even the average person, why can cash value life insurance sometimes be positioned like as a bond alternative or as a volatility buffer inside an overall retirement strategy? Because you're not saying don't put any money in a 401k. You're just saying don't overfund it. Don't have that be your only tool. So how can cash value life insurance fit into an overall plan?
I think that's a really good way to look at it, because I think there's this false binary that a lot of people have where they're like, oh, it's one or the other. And which one do I do? And it's like, well, what do you mean, which one do you do? Is that the right way to think about it? Like if you're thinking about like feeding yourself, for example, it's like, do I eat dinner or do I take a drink of water? And it's like, you should drink water and eat dinner, right?
So
like
breakfast or
you should be doing
or carbs.
Right. Everything comes in to balance. So the money in the market, your IRAs, your 401ks, your stocks, bonds, mutual funds, things like that, that's all well and good, but there's going to be times that markets go down and those will go down. So you don't necessarily want all of your money in the market, because when the market's doing well, you're making money. But we all know that the market doesn't go up every year. What is it? Like every 6 to 10 years, the stock market goes down by like 30%. So what happens when you're retired and you go through a 30% dip in the market? When you're 35, 40, even 50, it's not a huge problem. But when you're 75 and the market goes down 30%, you're screwed unless you have a significant amount of money that's not in the market. So what do you do?
Like for younger people, I think it could be helpful. And correct me if I'm wrong. I think there's a lot of like newer investors. The last 2 or 3 years, the market's been going up. So they don't know a bear market. They've never experienced anything like the dot-com crash or the great financial crisis. Or even in 2022, it went down 20 or 25% that year. Newer investors have never experienced that. But I've been doing this for 13 years and you've been doing it for almost 10. I've found for younger investors, just having a portion of their money in cash value life insurance to help them weather those financial storms when they do come, that mental framework of, yes, this money over here, it's like getting crushed. But my life insurance money, not only is it not going down, like in a whole life policy, it's actually still going up 4, 5, 6% every year. And I think just from a mental framework, that's really helpful to have them keep a long-term focus and stay the course with the investment side during those times where those investments are getting hammered. Do you agree with that?
I think that's a really good way to look at it. Is there's something to be said about the human behavior element when it comes to saving your money and long-term financial guidance. Everybody knows that, oh, just put your money in the market long-term, and you don't lose money if you don't sell. You don't have a loss unless you sell. That all sounds good on paper until you're actually going through it. It's like you see those people watch videos on YouTube of like a fight or a shootout or something, and they're like, oh, well, if that person did that to me, I would have moved this way, and I would. It's like, sure you would, pal. Like, I'm sure you would. Like you'd get your ass kicked. Really? Like, come on. Like we're gonna Monday night quarterback this situation, this like high stress situation, and when you're actually in the throes of it, you're gonna be, well, I would have this, I would have that. It's like, nah, you would have got beat up just like the other guy did in the video. Just like really, when you look at the numbers with market downturns, and they're like, oh, well, I wouldn't have sold. I would have bought more. It's like, no, you wouldn't have bought more. You would have probably panicked like everybody else did. And that's what the statistics show. You look at the average American, the statistics show that something like 80 to 90% of people, when they're losing money, they pull out because they can't. But like you said about having that cushion, that whole life policy or that IUL, it can help remove some of that mental distress. And you see your other accounts going down. You're like, oh, wait a minute. I got all this money over here that's not really affected by any of this craziness. So I can breathe a sigh of relief. This money over here is not doing great. And that can help people stay the course because they have almost like a permission slip to have some of that money exposed to risk because they have that foundation. They have that safety net already established.
That's amazing. Great stuff, Mike. Well, listen, brother, I think this has been such a valuable conversation. I really appreciate you joining me here.
Right on.